Let's talk about the Advanced Premium Tax Credit, or APTC. If you choose a healthcare plan from the new insurance marketplace, Covered California, you may qualify for tax credits if you meet certain eligibility requirements. This means that the government will pay a percentage of your monthly premium, the monthly cost necessary to keep your health insurance plan. So how is the amount of tax credit assistance calculated? The amount of assistance you can receive is based on your estimated income for the upcoming year, or your modified adjusted gross income, line number 37 on your federal 1040 tax statement, as compared to the national federal poverty level. The federal poverty line, or FPL, is used as a guide to determine eligibility for government assistance, and the amount of assistance varies by family size and age. But in general, if your income is below the 100 to 400% set federal poverty level, then your health insurance will be completely covered by the state, called Medi-Cal. If your income is somewhere between 100 and 400% of the FPL, you'll most likely qualify for a federal tax credit, officially called the Advanced Premium Tax Credit, where the government will pay a portion of your monthly premium. If your income is above 400% of the FPL, you will most likely not qualify for tax credit assistance and will be responsible to pay the entire premium of the plan you choose. Keep in mind, if you or your spouse have access to insurance through an employer, you may not be eligible for tax credits. The exception is that if the insurance offered by your employer costs more than 9.5% of your monthly income, as recorded on your W-2, for whichever spouse has the employer-offered coverage, you may still qualify for these credits. Insurance specialists at My Benefit Package can help individuals, families, and businesses through this often confusing process. There is some fine print though. Because the tax credit is based on an estimated income, the government can collect money at the time of your tax return when they cross-reference your tax return and discover that your actual income varies from your previous estimated income. Let's look at an example. Sam is a 35-year-old individual who enrolls for insurance through Covered California. Sam, at the time of enrollment, estimated that his income for 2016 was going to be $30,000. At the end of 2016, when the government audited his income information, they found out that he actually made $40,000. This means that the IRS will collect back the previous tax credit, and he will pay around $1,200 or more at the end of the year to reconcile or adjust the advanced tax credits or discounts he received the prior year. So, if Sam's actual income is within 10% of his estimated income he used at the time of enrollment, he'll be fine, and he won't have to pay anything at tax time. If Sam's actual 2016 income is lower than his estimated income, he will receive money back on his tax return. And if Sam's actual income for 2016 is higher than his estimated income, the government will take a percentage of the tax credit back at the time of his tax return, up to 100%. To summarize, Americans with low to moderate incomes may qualify for these government tax credits, a dollar-for-dollar reduction to help you enroll and obtain affordable health care to keep money in your pocket. Don't pass up this opportunity to qualify for these tax credits, and talk to an expert at My Benefit Package today to see if you qualify and to help you through this process.